So can we talk about one thing which I know you've had some experience recently is the effects of liquidity in portfolio. And even that example when you said before about, all right, just go buy another property, there's some other things that you need to make sure you have the means to be able to fund that property, the interest payments, factor in the interest rate rises. How do you approach liquidity management?
Sure. So in the good old days, so this is pre-GFC, kind of 2008, you could get a low doc or a no doc loan. So you literally, your name could be Mickey Mouse, you tick a box and say, I can borrow 80%. And that was the good old days. Unfortunately, they're long gone now. So the main thing is banks want serviceability. So even if you had $1 million paid off property, they're not going to lend you a cent unless you actually earn some money. So for this 28-year-old, then she might have 200 grand's worth of equity, but unless she's got a job, she's not going to be able to pull it out. So typically I'll try and refinance maybe every 6 or 12 months, pull the equity out, and then split it between having it as a buffer to help cash flow the negative gearing, because quite often you're negative geared, having money to reinvest in more properties to build a portfolio, and then spend money for me. And my job as an investor now is buying the property, renovating, managing it. That's easy. That's the last 5%. Once you've got a few properties, your job as a property investor is getting money from the bank. And it's doing big borrowing or stealing, obviously not stealing, and doing everything above the law. But it's, you need to understand the banks. You've got to get the best brokers, and you've got to do whatever it takes. So if you need 5 jobs, go get 5 jobs.
Yep.
If you need to declare more income, so as self-employed people, ideally you want to pay the least amount of tax. So you put all your expenses through, obviously all legitimate and stuff like that, but you want to minimize tax. As an investor now, I'm almost maximizing tax because I need higher incomes, and sure, I might pay more tax, but even if I pay another 100 or 200 grand in tax, if I can make another $1 million from my properties, it's worth it. So accountants and our parents were always telling us to get rich by saving money. Now it's all about the net return you get. So pay another 200 grand in tax, make an extra $1 million, your net is 800. Or pay another 20 grand in tax, make another 100 on another property, and your net 80. So whatever your numbers are, it's just zeros at the end.
And I think, obviously that was quite technical and there was a lot of numbers, but with Chris,
That's
I know...
when you need a coach.
Yeah, you do.
You need a wealth enhancers coach to take you step by step through it.
You do, and also that was a lot of foresight by you. Like you anticipated what was occurring, and it was a sort of a year in process, wasn't it? And I see one of the biggest costs to people's net wealth is selling investments at the wrong time. And one of the causes of that is actually liquidity. And we always have this saying about property is like, you can't sell down a bathroom if you need some money. Like it's a chunky exercise, and whereas the biggest expenses is actually on the transaction side, and that's why you don't sell any properties, is it?
Sure. So a lot of people say, oh, the taxes in property are ridiculous, like there's the land tax and the selling costs and capital gains. But I actually think that as property investors, we're actually pretty lucky because sure, we pay 5% costs when we go in for stamp duty and legals. We might pay a bit of land tax, but the land tax is actually, even though it's 1.6% or something, it's only about 0.5% of the property value. So on $1 million property, it's only 5 grand to bring you on your estate and stuff. Whereas your biggest cost is your interest, which could be 40 or 50 grand. But it's only because you write a check for it that people get emotional over it. That's the thing. And so if you pull it out of buffer, it doesn't really matter. But if I make $1 million on my property and I can refinance it, I pay compound interest of 4 or 5%. That's better than paying 50% tax or 25% capital gains. So I think as property investors, we're actually really lucky as long as you don't sell.
Definitely. And I think, so Chris knows the property market better than anyone, has a lot of opportunities, but he's not going out and buying 10 properties every year, are you? Because you want to actually be able to manage it within your lifestyle. And you know that, all right, you want to be able to take a month off and come to Aspen or something like that. And by having that stress of too much mortgage debt can actually influence your lifestyle. And we see that a lot of time with our generation. They go and buy this big property and they're all excited. And then 3 years later, they're like, oh, I actually don't like this job anymore. I want to go to a smaller job, and they can't because they're stressed out. And that's where you've got to buy within your means.
Yeah, it's all about balance. And look, I'm an ex-accountant, so I know my numbers. So again, as if you're not, that's when you need coaches and accountants and bookkeepers to work those numbers. So I'm very spot on with my numbers. But look, it's a balance. Is you've got to reward yourself. So even at 24, then I bought myself a second-hand Porsche out of the proceeds. But rather than sell the property and buy the Porsche, I kept the property, and that's gone from 80 to 100. Bought the Porsche, but now it's gone from 100 to 400 or 500. Yep. So you've got to keep the assets. But yeah, knowing your numbers. And look, some years you might buy 2 or 3, and then you don't buy anything for 2 or 3 years because it's part of the cycle.
Yeah.
But it's keep pushing yourself. And in the early days, rather, you'd be at 80% finance. Now I'm trying to get down to 60 or 50 because interest rates could be at 8 or 10%.
Yeah.
And that was your question before.
Yeah.
Is they are so low, there's only one way they can go. And I don't know if it's going to take a year or 10 years, but I know they're going to go up.
You do, and I think we have a very short-term memory about interest rates. Like, they've been 17% in the past. Like, do the numbers on your mortgage and go, what would happen if it went to 5-10%?
It's a massive difference. So in my book, the Effortless Empire, so we kind of reorder about 10,000 copies every year. And I thought, this year, do I move the interest rate down to 4 or 5? And I thought, no. In the book, I have it at 7, 8, and 9% as an average, best case, worst case scenario. It still works at 7, 8, and 9%. So rather than get the skeptic saying, oh, Chris, it's working at 4 or 5, I leave it in my book at 7, 8, and 9.
Definitely.